Hey there, my name is Tom Nash. Welcome back to another video. If this is your first time here, relax. We run the show a little bit different here than other channels you may have been accustomed to. Number one, you're gonna get the bottom line in the beginning of the video, not at the end. So you don't have to watch the entire video if you don't have the time. I'm fine with it. The second part, you can relax. There's nothing to buy, nothing to smash, nothing to like. So don't click nothing, don't smash nothing, don't buy nothing. Just relax and listen. So Tom Lee became, over the past 18 months, as the voice of reason for a lot of investors. And rightfully so. He called a lot of what happened over the past 18 months right on the money. He said that the market is going to do great things in 2023, which it did. He went against the grain on that. He also said that 2024 is going to see new highs for the S&P 500. And we went way past his original prediction because he said 5,200. People said, well, Tom, you are a permeable. You don't know what you're talking about. We're already at 5,500. And now people are asking him to give a new price target. Are we going up or are we going down? Now, Tom Lee came on CNBC and he dropped a lot of truth bombs. A lot of smart things that investors need to hear. Number one, he talked about the importance of understanding how to operate in an all-time high environment. Number two, what is the direction of inflation right now because it's going to have a huge impact on the market. And number three, he did release a new price target. So as promised, the bottom line first, the new price target for Tom Lee for the S&P 500 by the end of 2024 is 5,800. Current at 5,500, so another 300 points. Now, if you just needed that, fine. No problem. I'm not angry if you leave now. But I suggest that if you got a few minutes, you stick around because his explanation about inflation and his explanation about how to operate in an all-time high environment is actually very important. And I think every investor needs to hear this.
You know, I know investors generally aren't comfortable buying things at a high, but if we're mid-cycle, which we probably are, then we're going to be making a lot of new highs over the next 5 years anyways. And I think there's a lot of statistical support showing buying at new highs actually has a better win ratio than attempting to buy at low. I think as long as there's skeptics out there, that means there's a lot of fuel for upside. You know, there's a lot of people trying to top tick NVIDIA, saying that they don't want to own it because it's expensive, but it's a 30 PE stock that sells something that no one else actually produces in the world.
The one thing it's not is expensive.
Yeah. So I'd say I'd feel very differently if we were discounting NVIDIA being larger than global GDP and at 100 PE, and everyone's saying there's no way it can be stopped. But because everyone wants to sell NVIDIA and try to call a top, I actually think there's still a lot of upside. It's almost like if someone said, I'm selling because everyone owns the S&P. I mean, everyone should own some S&P. It's really a bearish sign when someone says the S&P won't ever go down. And I only hear people saying the S&P's topping right now. The big lesson for the last 2 years is the S&P has endured some pretty severe rate hikes. So we know companies are managing this cycle well. If the Fed turns neutral or dovish, that's even more positive for stocks. So I think that the environment for equities still is good because they survived a stress test.
Now, Tom Lee is no stranger to going against the common wisdom, against the grain. He basically plays his own game. And what he's saying here kind of goes against what most average investors do. Whenever a stock or the entire index goes to a new all-time high, they get nervous. They panic. Tom Lee is saying you shouldn't do that. The all-time high in itself doesn't really represent a risk. Every time we had a crash, we hit an all-time high just before that. But not every time we hit all-time highs, the market crashed. In fact, if you go back 75 years, over the past 75 years, we had 1,250 all-time highs. That's a lot. That's 16 per year on average. Did the market crash every single time that happened? No. Now, what Tom Lee is saying is pay attention. You need to understand whether we are mid-cycle and we have a lot more all-time highs to go forward, or we're nearing the end and we're running on fumes and the market is about to collapse. That's what you need to be looking at, not the all-time high in itself. And what he's saying is that he thinks we're mid-cycle. And his reasons are as follows. He's saying, look, there's a lot of people right now that are talking about being nervous, calling the top. The markets usually don't collapse and pull back like crazy when the market is nervous. It usually comes in with greed or extreme greed. With the nervousness in the market, with all the top callers, basically the people are saying, hey, this is the top, That shows him that we're not there yet. He's basically saying you need to be nervous when every single person out there tells you that stocks just can't go down. Another thing he says is that statistics show that trying to find the bottom is not a good exercise, while buying at all-time highs statistically serves investors much better than trying to find the bottom of a declining market. Now, what he's also saying is that we have Nvidia currently at 30 PE. 30 PE, it's simply not expensive. If Nvidia is kind of the barometer of this market, right? If Nvidia is the flagship of what's going on right now, the most hyped up, talked about company, everybody wants to own it. The Shushan boy talks about Nvidia, right? But it is still trading at 30 forward PE. At 30 forward PE, it's not expensive. There's no way you can convince any normal, reasonable investor that this stock is running out of control. Now, another thing he's talking about here is that this market right now is simply in a very accommodating environment. While the Fed raised rates at the fastest pace we've seen since the Paul Volcker days in the 80s, the market basically took it in stride. Earnings seasons was great, unemployment isn't skyrocketing, the GDP is growing, so the entire setup is holding up nicely with that 5% interest environment. And it's doing that in stride. However, what he's also saying here is that if the Federal Reserve decides not to cut rates, well, the market is going to keep going the way it just did right now. But if the Federal Reserve actually cuts rates at least once, it's going to set off in motion a whole new avalanche of money which is trying to get back into the market. Now, what he's talking about is two separate things. On the one hand, we have the $6 trillion parked on the sideline. If the Federal Reserve drops rates, and this is the end of the restrictive policy, and the Federal Reserve basically says, hey, we're done, inflation is finished, we're basically going back. In this scenario, that $6 trillion or a big portion of will have to jump back in because they're going to miss out on another 30% just like they did in 2023. Now, the other part here is the small caps. Tom Lee has been talking about the small caps and this rubber band effect for a while. The Russell 2000, while the NASDAQ and the S&P 500 pretty much did nothing over the past year. What Tom Lee is saying is because these companies are super sensitive to interest rates, once the Federal Reserve actually drops rates, they're going to have to catch up the lag that they've created with the S&P 500 and the NASDAQ. And that catch-up is going to be violent towards the top. And a lot of people are going to make a lot of money.
Our target for 2024 was 5,200, which at the time was almost 20% upside. Now our 5,200 is low because we're above that level. Then you get into the 5,800-ish level.
And now let's talk about the 5,800 price target. Now, Tom Lee basically set a new price target for the S&P 500 by the end of 2024. And he says it will go from 5,500, which is all-time high, to 5,800 in the next 6 months. Now, his rationale is very simple. He's basically saying, look, earnings are great. And number two, inflation is dropping towards 2%. You can't stop it right now.
I think the war on inflation has been meaningfully better in terms of progress. I know there was a lot of dispute, but I think the last two inflation reports and the fact that 55% of inflation components are back to pre-pandemic levels means inflation is really going to fall like a rock.
He's basically saying, look, the only thing that's holding up inflation right now is lagging indicators such as shelter, such as auto insurance, things you change and you repurchase once per year. So it's going to take time for these to actually get reflected in the new inflationary environment. He basically says, look, we had great results on the market, as I mentioned earlier, with 5% interest. No problem. Once inflation basically goes to 2%, once the Federal Reserve starts cutting rates, it's just going to amplify the current process of the market and the current earnings environment, which is going to send the market to that 5,800 price target, according to Tom Lee. Now, Tom Lee also says here, look, I know you're all focused on the S&P 500, and I get it. But pay attention to the Russell, the small caps, which I just mentioned a second ago. He's saying, look, the median PE on the Russell is 11, is way, way lower than the S&P 500. Now, that is historically, statistically, a great entry point before it goes out of the stratosphere with the new, lower, more accommodative interest rate environment. Now, Tom Lee talked about the all-time highs on the market, the all-time highs on Nvidia, and I want to kind of elaborate on this. If you look at the S&P 500 right now, we're up 14% year to date. The average 6-month return on the S&P 500 is about 4.7%. So we're almost triple that. We haven't had a 2% single drop day on the S&P 500 in over 300 days. That's the longest streak we had since 2007. By the way, that streak was 949 days. So we're still far away from that as well. Nvidia is up 200% of the past 12 months. And obviously that makes a lot of investors nervous. I mean, whenever the stock price of Nvidia goes up 200%, whenever the index goes 3 times more than it should, people get anxious, they get nervous. And Tom Lee in this video says, hey, don't be. There's no reason. We're mid-cycle. Everything is fine. You shouldn't be freaking out just because we're in all-time highs. Inflation is dropping. The market is doing great. The macroeconomics are great. We're heading to 5,800. Everything is fine. Now, what I want to offer to you right now is some of my insights. Ever since the release of ChatGPT in November of 2021, the NASDAQ is up 32%, which is great. The only problem is that the invention of Netscape in 1994, which was just as important, and I'd argue that ChatGPT is a little bit more important than Netscape, the Nasdaq rose 110% in 2 years. We are 18 months removed from the invention of ChatGPT, and we're up 32%. So according to this statistic, we have another 70, 80, 90% to go. Now, I'm going to agree here with Tom Lee that all-time highs on their own, they're meaningless. They're not a bad indicator. I mean, especially if those all-time highs are supported by great earnings, by really normal multiples with Nvidia being 35, by a median PE on the S&P 500 which is below 20. This is not necessarily a bad thing. Now, his argument about the $6 trillion on the sideline is partially correct. Yes, there's a lot of money on the sideline and the total amount is $6 trillion, but some of it is just going to stay there because people want to be in money market accounts for risk management, for a lot of reasons. I believe that the amount that's supposed to come back to the market from money market accounts is closer to $1.5 trillion, not the entire 6. But trust me, if $1.5 trillion goes from money market accounts into the market, into equities, it's going to be a pandemonium. You don't need the entire $6 trillion to do what Tom Lee is saying the market is going to do. Now, since November 2021, again, the invention of ChatGPT, the S&P 500 is up 30%. Not bad, right? Now, the average bull market in the US is a 100% increase on the S&P 500. So we're not even close. We're still like 70% away from the average bull market. And especially with looking with the AI cycle generating so much revenue, so much profitability for companies like Nvidia, like Palantir, like Microsoft. A lot of companies are basically generating genuine funds, money, free cash flow, profitability out of this. So this is not just vaporware like we had in 1999, where people say the word .com and all of a sudden the stock pops. The fundamentals do support this. Now, also, people kind of forget that this is an election year. After that debate, it's kind of hard to forget. But hey, on an average election year, the S&P 500 is a 10% market. We're a little bit above that right now. But all I'm saying that markets don't usually drop in an election year, especially if the earning guidance for the next few quarters is stellar, especially if you have job numbers that are okay, GDP is growing nicely, inflation is actually dropping. I mean, all signs point to the fact that Tom Lee is right. It doesn't mean we can't have turbulence. It doesn't mean the market can't drop like crazy. The market goes up in the stairs and drops in the elevators. We talked about it. The S&P 500 drops 5% at least 3 times a year and 10% at least every third year. So there's a lot of droppage coming in the middle of this bull cycle. It doesn't mean you have to shoot up like a 45-degree angle. That's not how it works. And in these clips, Tom Lee also talks about Nvidia, saying, look, despite the hype, despite the craziness, the frenzy that is around Nvidia, somehow this stock is still not expensive. It's trading at a forward PE of 35. By the way, I don't suggest you look at current PE, look at forward PE. Current PE are history. Now, I've been making videos about Nvidia for the past 4 years. Our first video was back in 2021. We've done multiple videos telling people this company is a game changer. In fact, our most recent one, I believe, was 6 months ago when we said, hey, this thing is going to go to the moon again. And since then, we've done 90% on this stock as well. So our community has been doing fine with Nvidia. And you should consider joining. I mean, it's free to join. You subscribe to the channel, you join the Discord, which is free to join, and you're part of the community. By the way, discord.gg/TomNash, that's how you join the community. It's free to join. So I tend to agree with Tom Lee. Look, 35 PE is just not expensive. You have a top 5 CEO with Jensen, hands down. Some might say top 3 CEO. Some might say the best CEO, but definitely top 5. This company is currently priced at 40% revenue growth for the next 5 years. With the way the capex cycle in the AI industry is going, I don't think that is an ambitious target. In fact, I think that NVIDIA is going to beat that with ease. These capex cycles are not what Cisco had in 1999, where everything collapsed. It's not telecom. The life cycle of these chips, of these servers, is probably in the 2 to 3 year area. It's not the same as laying down fiber optic cables. You see, the H200, which is the top of the line, which literally nobody else has, and everybody wants the NVIDIA H200, they already have a replacement for that. The Blackwell is going to replace the H200, and it's not even been 2 years yet. So the cycles on the capex spending by NVIDIA customers isn't going to stop next year and 2 years and 3 years. As long as AI is a thing, this is going to continue for years and years and years. I believe NVIDIA has a lot of good years in the tank, especially with no foreseeable competitors that are about to take their lunch. I mean, where's the competition? Now, the big question here is what to do with all this information. Obviously, I agree with Tom Lee. We're about to hit another high on the market. NVIDIA is nowhere close to being at the top. So the natural conclusion of the normal average investor would be to go all in right now. Take all the money they have and buy NVIDIA and buy the S&P 500 and just sit there and wait for the next 3, 4, 5 years. Now, I don't believe that this is the best strategy to invest. In fact, I believe that this strategy is not going to be rewarding to investors, and this is not what I teach in my community. My students, my community members are doing this different. We don't go all in, we don't FOMO. What we do is slowly buy every single week, every single month, dollar cost average at all times, regardless of the stock price. The only time we look at the stock price or the index price is whether we need to make a decision on doubling down our DCA. So we buy at all times, we don't stop. So once a stock or even the index itself drops below a certain threshold point, below a certain price, my students, my community members, they start increasing the amount of their buys. Instead of buying 200 every week, they'll buy 400 every week. And they keep doing it like a robot until the price goes back up and goes above the threshold point. Now, with these results, you can't argue. And I'm going to show you actual examples, real life examples of how this system made money for people. And it's not that complicated. In fact, it's very, very simple. All you need is some discipline. Look, my community member, Arthur, he's a Rivian fan. He decided he wants to invest in Rivian. Cool. Okay. He started investing when the price was in the 20s, $20 plus. But he kept dollar cost averaging as the stock price dropped and dropped and dropped, while most average investors got freaked out and sold or held on. He kept on buying and he kept on lowering his average all the way to $8 per share. And now that we have the VW deal, the stock price popped. If he just would have went all in and held on at $20 per share, he would still be down on his original investment. That system has made him a lot of money. Now, my community member, Peter, another great example, he started investing in Palantir in 2022 when the stock price was $13. Now, he could have held on to $13 and he would have been up 100% right now. Cool. But what he did, he kept DCAing, buying more and more as the stock price dropped, lowering his cost basis in Palantir to $9.8. By the way, that same guy has been dollar cost averaging into Microsoft since 1997. And you know what? He's up 2,500% on that DCA as well. Now, my community member Chuck is the best example of them all. Chuck bought Palantir right at the top at $21 per share. If he would have bought it, held on to it, he would still be up $3, like 10% on his original investment. That's great. But what he did, as you can see on the screen right now, he kept on buying and he kept on buying more and more, increasing the amount of purchases as the stock price dropped. Right now, he's sitting on an average of $8.73 per share, all the way from $22. So he's up to 100% instead of 10% by dollar cost averaging for 2 years into weakness. That's it. And obviously, you're invited to join our Discord. It is free to join, discord.gg/Tom Nash. We have 12,000 new members right now on it. We had 5,000 just a couple of weeks ago. We would love to have you on there. You can also become an Academy member for more advanced strategies, actual weekly lessons at patreon.com/Tom Nash. And if you are a highly advanced user, check out stock-mvp.com. If you actually want to model your own stocks, if you want to research stocks, do your own DCFs, and actually do some real work about stocks, equities research, stock-mvp.com is a platform I built for you specifically. That's only for advanced users. All the details are below. Now, as expected, every good thing, word gets around. Over the past 28 days, our YouTube channel grew by 12,000 subscribers. Now, obviously, that's great, but for me, it's a little bit too fast. I want to make sure I give enough attention and kind of manage the community so nobody gets left out. I want to make sure I can handle this. So in about 2 days, we're going to shut down all the invites, all the joins to the community. They're going to be closed. The entire month of July, we're not going to have any new members in the community, in the Discord, and the Patreon. So that's going to be shut off for the next 30 days. We need to figure out how we actually manage this better. We need new moderators. We need a lot of new stuff. If you want to join now, and then we're going to shut it down. We're probably going to reopen it towards the beginning of August, maybe the middle of August. So I'm not shutting it down completely forever, but we're going to take a little break. Thank you as always. I'll see you in the next one.